Okay, let's unpack this.
Let's do it.
We are diving into something exceptionally fresh today. A project called Surfcash. The token is SURF.
And when you say fresh, you mean it. This thing is barely 2 weeks old.
Yeah, it launched just 13 days ago on December 10th, 2025, right in the heart of the Solana ecosystem.
And that age, 13 days, that's absolutely central to the mission for you, the listener.
Yeah.
We're not looking at some mature protocol here.
Not at all.
We're analyzing a proof of concept in its absolute infancy. It's a classic microcap scenario where, the potential returns are matched only by the structural risks.
So for some context, what are we talking about numbers-wise?
Right now, as of the analysis, the project's trading with a pretty modest market cap. It's hovering between, say, $2.2 and $2.5 million.
Okay.
And that's supported by about $1.8 million in circulating value.
So essentially, this early stage means any investment is, it's fundamentally a bet on execution risk.
100%.
The project's pitch is super ambitious. It positions itself as a neobank, but one designed specifically for digital nomads, global travelers, and the emerging market user.
And it's focusing on solving that really persistent, thorny problem of crypto to fiat conversion.
But the source material gives us this stark dichotomy, right? And that's the tension we really need to resolve today.
That tension is what makes this so fascinating. On one side, you find some really impressive institutional validation and a genuinely strong real-world utility. I mean, it's almost unique for a project this small.
But on the other side,
On the other side, you see these critical foundational risks, and they're rooted really deeply in its tokenomics, the very financial structure of the token itself.
so our deep dive mission today is to weigh those two sides. We've got the qualitative strength of the team and the utility versus the quantitative weakness in the financial engineering.
And we're going to try and figure out what, if anything, justifies this early market attention. It's really an evaluation of potential versus structure.
All right, let's start where the analysis is strongest then, the utility. The report actually rates the narrative positioning as strong. What makes it so compelling?
It's because it attacks a friction point that, is often overlooked by these huge DeFi protocols. But it's something that's deeply felt by millions of people all over the world.
And what is that pain point exactly?
It's simple, but it's structurally really significant.
Yeah.
How do you seamlessly spend stablecoins, specifically USDC, at a local merchant who only accepts local currency?
Right.
Imagine you're traveling through Southeast Asia or South America. You've earned in crypto, but you need to pay a street vendor, a local taxi, a small hotel.
Yeah, the current solutions are just awful. They're multi-step processes. You have to transfer to an exchange, wait for verification, maybe an expensive wire transfer to a bank.
Or an ATM withdrawal with just exorbitant fees. It's a mess.
And often that local merchant doesn't even have a bank account that can receive a standard international transfer. That just makes the problem even worse, especially in emerging economies.
Exactly. You're trying to use this global, decentralized asset in a hyperlocal, cash-dependent, or a hyper-localized digital payment economy. The two just don't mesh.
So how does Surfcash claim to fix this?
Well, their solution is designed to bypass this entire cumbersome infrastructure. On paper, at least, the mechanism is a pretty elegant bridge.
A bridge between crypto and local fiat.
Precisely. It enables the conversion of crypto USDC to local fiat currency, and they claim it's instantaneous, completed with just a simple QR code scan.
And what's the time frame on that?
Their claim, and it is a bold one, is that this entire process is completed within a rapid 30 seconds.
30 seconds. Wow, that's fast enough to make it a practical point-of-sale solution. You could actually use that at a coffee shop.
You could?
But that speed claim, it immediately raises a skeptical question for me. For a 30-second transaction to clear crypto conversion, confirmation on the blockchain, and fiat settlement, what specific technical advantages of Solana are they leveraging? And how are they managing the off-chain liquidity?
That is the million-dollar question, and that's where the choice of Solana is so crucial. Solana's fundamental advantage is its low latency, high throughput capacity. That's absolutely essential for any real-time payment network.
So if they were built on, say, an Ethereum L1, this would be impossible.
Impossible. A 30-second confirmation would be a pipe dream because of gas costs and block times. On Solana, block finality is near instant, which lets the on-chain validation happen super quickly.
And the off-chain part.
The off-chain component relies heavily on pre-funded liquidity pools, and this is key, establish relationships with local payment processors or liquidity providers in their target countries.
And that right there is the execution risk we're going to come back to.
Exactly. That's the hard part.
The analysis highlights that this utility isn't just about, traveler convenience. It addresses structural exclusion for the unbanked and underbanked populations in emerging markets.
Absolutely. This is where crypto-native payment solutions can really leapfrog decades of traditional, expensive banking infrastructure that often excludes lower-income citizens.
Right, because traditional finance requires credit checks, physical addresses, extensive KYC, things that many people in developing nations just can't provide.
Exactly. Crypto, accessed via a smartphone, is inherently more inclusive. Surfcash is positioning itself as a way for these populations to use stable, dollar-backed assets like USDC in their daily lives without ever needing a Chase or a HSBC account.
And the source material focuses on three key target markets where this friction is most acute: Vietnam, the Philippines, and Brazil.
And those are not arbitrary choices. Vietnam and the Philippines are major hubs for digital nomads, remote workers, and they have a high remittance dependence.
Okay, so a lot of money flowing across borders.
A ton. And there are also regulatory environments where crypto adoption is growing fast, but traditional banking remains slow and fragmented.
And Brazil?
Brazil, similarly, has this massive domestic digital payment adoption. Think of Pix. But integrating international crypto payments into that infrastructure is the missing link. So Surfcash is targeting countries where the friction, and thus the demand, is highest.
And if we connect the brand name, Surfcash, back to the team's stated philosophy, it all starts to click. It's not some dry financial product.
Not at all. It's intrinsically linked to a lifestyle. That narrative strength is extremely powerful in crypto marketing.
So Surfcash encapsulates that freedom of movement, the ability to work globally.
And have instant access to liquidity wherever you are in the world.
That's it.
This is not some abstract DeFi concept. It's a tool built for a tangible, documented community.
Yeah.
And that resonance makes the narrative inherently more sustainable than typical speculative projects that rely purely on algorithmic promises.
It gives them a foundational advantage, a genuine real-world payment problem being addressed by a highly specialized solution anchored to a major blockchain.
Right.
But that advantage only matters if the team can actually execute on it, which brings us to the founders.
Exactly. Utility is only potential until the product is launched and scaled.
Okay, let's pivot from the what that strong utility to the who. Because in a 13-day-old microcap project, the team's track record and credibility are, they're your most important form of collateral.
They're everything.
So we know the co-founders are Ashad and Caesar, and the CTO is a guy named Chester. This level of transparency, just identifying key personnel at this stage, that's already a positive signal.
It definitely raises the bar beyond the anonymous microcaps that just dominate the Solana scene. What's particularly fascinating here is the shared history and the ecosystem immersion.
The analysis notes they didn't just meet on a Zoom call. They met at the Solana founders' villa. That seems like an important detail.
It is. It suggests they came up through the rigorous development ecosystem that was fostered by the Solana Foundation itself. These aren't outsiders.
And their collective background is cited as encompassing expertise across over 70 countries. That's not just a nice biographical detail, is it?
No, for a project aiming to integrate with dozens of different fiat and regulatory environments, that depth of cross-border experience is invaluable. It mitigates the immediate risk that they're building a product based on assumptions rather than lived experience.
Right. A team that's navigated 70 countries probably understands the granular differences between, say, Vietnam's QR payment adoption and Brazil's instant payment infrastructure.
Exactly.
The sources make a point of highlighting that this team navigated Solana's previous bear markets together. They call it trauma bonding. I want to push back on that a bit.
Okay.
Does surviving a crypto winter necessarily prove their ability to scale an actual high-volume regulated payment service? That faces competitive pressures, regulatory hurdles. It's different than just surviving internal development cycles.
That's a fair challenge.
Yeah.
Survival during a bear market speaks primarily to resilience and commitment to the underlying technology, which is crucial for morale. But you are absolutely right. It doesn't automatically confer competency in high-scale execution.
So what does it signal then?
It signals that they are builders focused on infrastructure rather than just price action.
Yeah.
They chose to stay in the ecosystem and continue building, which, in the context of Solana's history, suggests a deep faith in the platform.
That focus on infrastructure is directly supported by the identification of Chester as the CPO. He's described specifically as a long-term Solana hero with relevant technical depth in payment systems.
Yeah.
Why is naming an experienced, recognized CTO so crucial for mitigating execution risk in a payment project?
Because execution risk is the single largest threat to a utility-focused project like this. A payment network isn't just a smart contract. It requires seamless back-end integration API calls, liquidity management, security, the reliable flow of data across sovereign borders.
It's complex.
It's incredibly complex. Naming a veteran like Chesser, particularly one known within the Solana ecosystem for payment systems, provides concrete confidence that the foundational technical challenge making that 30-second transaction reliable is handled by someone who understands that complexity.
It signals a specialization that moves them beyond just generic DeFi developers. They're building a vertical solution.
Exactly. An anonymous team implies high execution risk. A named veteran CTO with specific payment system expertise implies a major reduction in that risk. You're betting on known talent rather than vague promises.
And here's where it gets really interesting and moves them into a completely different category. Let's talk about the institutional validation.
The Circle grant.
Securing a grant from Circle, the major stablecoin infrastructure provider behind USDC.
That is massive. A grant from Circle is not just a small seed investment, it is an endorsement of their technology stack and, maybe more importantly, their mission alignment.
What do you mean by a mission alignment?
Circle's strategic goal is the mass adoption and utility of USDC globally. If Surfcash succeeds in using USDC for point-of-sale transactions in Vietnam, the Philippines, and Brazil, that directly feeds Circle's core business model.
So Circle isn't just throwing money at some random Solana token. They're funding a distribution channel for their core product.
Precisely. And that kind of grant typically implies more than just money. It suggests potential access to Circle's API tools, maybe early access to regulatory guidance, and certainly a stamp of approval that facilitates future relationships.
So for a project tackling cross-border payments, having the support of the stablecoin issuer itself must dramatically simplify things.
It simplifies integration, compliance, and crucially, liquidity sourcing. It moves Surfcash out of the bucket of purely speculative microcaps and firmly into the category of infrastructure, plays with significant and very early institutional alignment.
Okay, so we have a credible team, deep ecosystem ties, and an anchor institution supporting the utility. That's a powerful combination.
It is.
But now we have to ask, how is that credibility translating into real-world engagement?
That's the necessary pivot. We need to look at the market footprint and see if the organic demand is actually validating this institutional confidence.
All right, moving on, let's analyze those early public-facing signals, the hard numbers that tell us who is paying attention and why. The marketing assessment is described as modest, but strategic.
And you can see that modesty starkly in the primary crypto communication channel, which is Twitter. They have only 2,900 followers.
That's tiny for a Solana launch.
It's a very small base. And the posting frequency is estimated at only 1 to 2 posts per week. That is significantly below the typical benchmark for a crypto microcap, which often aims for 3 to 5 posts per week just to stay relevant in the noise.
A low frequency like that usually signals one of two things. Either they are just intensely focused on building the product and are intentionally ignoring marketing,
Or they're severely under-resourced on the go-to-market side.
and the report seems to lean toward strategic.
The content strategy supports that interpretation. They aren't running hype campaigns, referral schemes, or, endless price prediction polls. Their focus is on product updates, governance announcements, and education.
Okay, so more substance, less hype.
Exactly. For example, the sources point to a detailed tokenomics announcement from December 3rd. It only received 45 likes. Very low. But it pulled in 9,585 views.
So what does that low-like, high-view ratio tell us about their audience?
This is a massive signal. If it were a typical speculative token, you'd see maybe 500 likes and 2,000 views high engagement from people trying to signal belief for a pump.
Right.
Here, the audience is clearly reading the document, reviewing the governance, and absorbing the details. It indicates they are attracting a serious, more informed audience interested in the fundamental mechanics and the product, rather than speculators just chasing immediate volatility.
But this leads us to the biggest and, I think, most compelling disconnect in the entire community analysis.
The waitlist.
The massive waitlist versus the tiny Twitter following.
Yes. Contrast those 2,900 public crypto followers with the reported 13,000-person waitlist for the Surfcash platform. So what does this all mean?
It has to mean there's a powerful stream of organic, non-crypto native demand.
That's the only logical conclusion.
So who is on that waitlist then?
Yeah.
If they aren't following the crypto conversation on Twitter, They must be the actual end users.
Digital nomads, global travelers, or potentially emerging market locals who are interested in the USDC utility.
So they're successfully penetrating their target communities, travel forums, digital nomad Slack groups, regional expat social media, which all operate outside the standard crypto echo chamber.
Exactly. This is a crucial distinction. The community they're building is the end user base, not necessarily the speculative retail investor base. This is the organic demand required to validate the utility we were just talking about.
Okay, so let's look at the financial behavior of the small crypto audience that is involved. Analyzing the on-chain sentiment, it seems to reveal some positive accumulation signals.
The raw data is pretty encouraging for conviction. You see 3,508 buy swaps versus 2,445 sell swaps since launch.
So a net positive buying pressure.
Substantial for a 13-day-old microcap? It suggests an accumulation mentality among the early participants. People are buying and holding, which is a strong signal of conviction in the project's long-term utility, rather than just flipping for a quick profit.
And considering this is a high volatility microcap, we would expect to see massive amounts of FUD fear, uncertainty, and doubt.
You expect the chat to be a mess.
Yet the report notes limited FUD. It even mentions only scattered commentary about relentless fudding by a tiny group of people.
Minimal community distress after a launch like this speaks volumes. When a token has a structural weakness, high volatility usually amplifies FUD, and that leads to panic selling. The fact that the community has remained relatively steady with consistent net buying pressure suggests the early adopter base values the utility and the team's narrative over short-term price anxiety. They seem to understand the risks and are committed to the long-term play. Okay, so to synthesize this section, the external metrics look kind of weak low followers, sparse posting, but the internal metrics are strong. High view counts on serious content, an overwhelming waitlist, and strong on-chain accumulation.
It's a project that speaks softly but carries a potentially big stick.
So it suggests that they are building a real business first, and the token is attracting those who understand that value proposition, not just those looking for immediate speculative yield.
Exactly.
All right, let's shift now to the technical foundation. As we've noted, Surfcash is built on Solana, using its speed for that core payment mechanism.
Right, and their positioning is sensible. The contract address is public and verifiable. Surf WRJQ, YOKey6, P7J, DHXX, PDF4, JDUA's PB888 Eora UAL Sistar, and it's trading on Meteora DAX.
Meteora is Solana's leading liquidity aggregator. Let's elaborate on why trading there matters, particularly its DAMM structure.
Okay, so a standard AMM is static, and that can lead to massive price slippage when liquidity is low. Meteora's dynamic AMM, or DAMM, structure allows liquidity to be dynamically rebalanced, which theoretically helps improve capital efficiency and smooths out some of that volatility.
But I'm guessing, given SURF's young age, the liquidity depth is still modest.
Very modest. It's noted between $258,000 and $286,000.
That's predictable for a 13-day-old token, but it carries inherent risk, especially for any potential institutional involvement or even just large trades.
Absolutely. Low depth means higher volatility and higher slippage for large buy-or-sell orders. A big whale could easily manipulate the price with a modest amount of capital.
But the on-chain distribution suggests they've mitigated some of that whale risk initially.
They have. The trading data shows 90 unique buyers and 88 unique sellers in recent activity.
So it's fragmented. That's a good sign against immediate centralization. The supply didn't just land in the hands of 3 massive dollars who could dump on the market at any time.
Right. It indicates a distribution consistent with an AMM launch, spreading the risk across a wider base of early participants.
Okay, now for the red flags. DEX screener flags one issue regarding the audit status, along with the standard caveat that audits may not be 100% accurate. This is the first technical warning.
That warning is standard, but it's crucial to acknowledge. For a project moving at this speed, deploying a functioning payment solution within 13 days of a token launch, there's an inherent trade-off.
So they're prioritizing speed over a perfect audit from day one.
Comprehensive, multi-stage smart contract audits from top firms can take months. Launching this quickly means accepting that the audit status may be incomplete or that preliminary findings might exist. It just confirms that smart contract risk remains a live factor for any early participants.
Okay, let's move to the most critical technical finding in the contract design itself.
The big one.
SURF is explicitly designed as a mintable token.
This is a fundamental structural decision and is a massive governance trade-off. Being mintable means the team, or eventually the DAO, retains the authority to create new tokens beyond the current circulating supply.
So they can just print more money, essentially.
They can. Now, this flexibility allows them to allocate tokens for crucial needs, future team incentives, strategic partnership grants, or expanding staking rewards, without having to buy them back from the open market.
So it gives them agility, which might be necessary for a fast-scaling utility project that needs to secure large partners.
Yes.
But it introduces an explicit and, frankly, existential risk for current holders. And that risk is dilution.
That's the core risk. Think of the current circulating supply, which started at 50% of the total as a fixed pie. If the team or the DAO exercises its minting rights, they essentially hold the ability to bake a second, potentially much larger pie tomorrow.
And everyone's current slice instantly shrinks.
Exactly. It places a massive amount of trust in the team and the eventual governance structure to use those minting rights responsibly and transparently.
The moment the token is mintable, the supply is no longer finite. This has huge implications, especially when we consider the next section.
The lack of a burn mechanism.
Yes. The mintable feature, combined with the lack of deflationary mechanics, creates a unique structural pressure.
Not only can the supply increase, but there's no counter mechanism to decrease it.
Mm-hmm.
This brings the entire tokenomics conversation to a head.
Here's where it gets really interesting and perhaps terrifying for the financial engineering side of the house. We need to focus on the single most important financial finding in this strategic analysis, because this is where Surfcash makes a truly non-standard choice for a microcap project.
We have to state this clearly and emphatically so the listener understands the gravity of this decision. Surfcash does not implement a burn mechanism.
At all.
There's no system in place, not transaction-based, not buyback-funded, to structurally reduce the supply of SRR tokens over time.
This choice immediately diverges from, well, pretty much all contemporary DeFi norms. If we connect this to the bigger picture, why is the absence of a burn mechanism such a monumental finding in today's crypto environment, where engineered scarcity is king?
Because the market has been trained, conditioned even, to demand deflation. Over the last 5 years, almost every successful protocol has introduced mechanics designed to create perceived or actual scarcity.
Like Ethereum.
Look at Ethereum, which implemented EIP 1559 to burn the base transaction fees. Look at Uniswap, which has an active governance proposal to enact a fee switch, often intended to fund buybacks and burns. These systems are designed to make the asset more scarce over time.
Which, in turn, structurally justifies a higher valuation because the total circulating supply is shrinking.
That's the theory. So whether a token uses transaction burns, like SafeMoon famously used to create hype, or automated buybacks funded by protocol revenue, the goal is always the same: reduce supply, drive scarcity, and anchor the valuation to the expectation of a future limited supply.
And Surfcash has none of that.
None. Their initial tokenomics were already adjusted to be fair. 50% of the total supply was circulating at launch, up from a planned 20%.
And while that was likely done to mitigate fears of a heavily centralized or VC-controlled launch,
it still means that half the supply is controlled by early participants like presale, team, and investors. Without deflationary pressure, that large initial circulating supply just remains an overhang.
okay, the fully diluted valuation, or FDV, is currently estimated between 2.2 and 2.5 million. This confirms they exceeded their minimum raise of $250K, securing initial operating capital.
Right.
But let's look at the financial structural gap created by their utility focus. Surfcash is a payment network. That means it will generate transaction fees. Payment networks typically charge between 0.5% and 1% per transaction.
This is the critical revenue mechanism. But here's the problem. There is no documented mechanism for routing those significant platform transaction fees back to SUR holders, or for using them to benefit the token value itself.
So wait, if I use the Surfcash app in Vietnam, I pay a 1% fee. Where does that 1% go?
It appears to accrue directly to the corporate entity or the development fund, not the token holders.
Wow. That is the implication. And that's a massive issue when you benchmark it against any successful crypto project that generates real revenue.
If you look at comparable payment or financial ecosystems, whether it's traditional like Stripe or PayPal or decentralized like Radium or Aave, they create token value by aligning platform revenue with token holders.
So if all the fee revenue just accrues to the company and not the token becomes purely an administrative governance, right? Not a profit share or a scarcity-driven asset.
That's it, which raises the crucial question.
If we have no burn mechanism and we have no revenue sharing or fee alignment, what is the value proposition of the SURF token?
The value proposition rests entirely on platform adoption and utility, specifically the governance rights and whatever future staking rewards they might introduce, which would rely
On new token minting, which just causes more dilution.
Exactly. So unlike tokens that are financially engineered for scarcity, SURF's potential appreciation is solely execution dependent.
It is a pure, unadulterated bet on product market fit. They have to succeed in onboarding merchants and users at a massive scale in developing economies to justify the FDV, because there is zero financial engineering to shore up the price if that adoption slows down.
Absolutely. The token has to compete purely on a utility and adoption metric, similar to how a traditional startup's valuation is based on price to earnings or network adoption. They have to demonstrate, say, 5 times the real-world utility of a competitor just to compensate for the fundamental lack of a supply sink.
And historically, utility-only tokens that lack financial incentive alignment, they often fail to maintain value in speculative crypto markets.
The market demands a yield or a deflationary narrative. This is an incredibly high-stakes, almost old-school Web 2 approach married to a cutting-edge technical solution.
It is. Now let's quickly touch on the one novel structural element they have mentioned.
The Futarchy-powered token ownership structure.
Futarchy. That's the governance model that combines prediction markets with DAO decisions. For anyone unfamiliar, how would this actually work, and why is it so innovative but so difficult to implement?
Futarchy essentially uses prediction markets to decide on governance actions. So instead of just voting yes or no on a proposal, token holders vote on whether they believe the proposal will increase the token price if it's implemented.
So the mechanism is the DAO should adopt policy X if and only if a prediction market believes that the token value will be higher if X is adopted than if it is not.
You've got it. So instead of being governed by ideology or politics, it's governed by the market's prediction of the policy's economic outcome. It forces governance to be inherently profit-seeking for the token holders, which should theoretically maximize the long-term economic health of the protocol.
But it's hard to do.
Notoriously difficult. Prediction markets themselves can be manipulated, and measuring the impact of a governance decision accurately is a complex oracle problem. Right now, its role in SUR is entirely undocumented. It's just narrative potential at this point.
But it does signal a deep focus on innovative governance structures, even if they bypass the standard scarcity structures.
It does.
So to summarize this critical section, SurfCash is betting that real-world utility and innovative governance are enough to overcome the fundamental lack of deflationary tokenomics that the speculative crypto market just demands. That is a truly courageous, or perhaps reckless, structural decision.
It forces us to ask, do they know something about long-term emerging market adoption that the rest of the DeFi world is missing? Or are they making a fatal financial misstep?
That sets up our final comparison perfectly. How does SurfCash stack up against its peers in this crowded microcap segment, particularly those focused on payments or infrastructure on Solana?
Well, tokens with a similar 2.2 to 2.5 million market cap, they all share the hallmarks of the microcap segment. You've got low trading volume ranges wide, anywhere from 47K to 462K daily in extreme volatility. Daily price swings of plus or minus 50% are common.
But the source material flags that key difference again. While SURF is volatile and small, many of its competitors implement stronger burn mechanics or guaranteed staking APYs to justify their early valuations and signal scarcity.
And that's the competitive battlefield.
Yeah.
SurfCash's competitive edge is massive. Real utility, that 30-second crypto-to-fiat conversion, and institutional backing from Circle. These are huge qualitative advantages over anonymous, purely speculative tokens that are just riding the Solana meme cycle.
They're building a genuine product.
They are. But the severe disadvantage is that absence of deflationary tokenomics. It forces the market to evaluate SURF based solely on the eventual success of the payment network, not on financial engineering tricks.
So let's break down the bull and bear cases using some concrete scenarios.
Okay, the bull case is compelling. SurfCash solves a real painful problem in massive underserved markets. It has experience, connected backing, and it's planning for innovative governance with Futarchy.
And if they capture even a tiny slice of the market?
If they capture just 1% of the digital nomad or emerging market cross-border payment flows in Vietnam alone, which handles billions in remittances, substantial, potentially explosive appreciation is possible. It's an asymmetric bet on scaling.
Okay, conversely, the bear case. It centers entirely on execution risk and those structural constraints.
The token value is totally dependent on them succeeding in three difficult, regulated, and culturally distinct markets: Vietnam, the Philippines, and Brazil. They need to acquire merchants, integrate with local fiat rails, and convince users to switch from established, if flawed, methods.
And that's a resource-intensive endeavor. That sparse marketing we talked about suggests two potential realities.
Either an almost arrogant confidence in organic word-of-mouth adoption from that 13,000-person waitlist, or, more concerningly, a genuinely under-resourced go-to-market strategy that just cannot compete with well-funded local fintech players.
And given the team's credibility, the first one is possible, but the second one remains a strong risk factor.
The ultimate success hinges on whether the team can successfully navigate the regulatory and logistical hurdles of scaling a real-world payment network. Can they acquire enough merchants in Hanoi, Manila, or Rio quickly enough to drive revenue before the current speculative interest just wanes?
That is the ultimate test. So our final assessment, it remains consistent with the report's conclusion.
It's a high-risk, execution-dependent bet on emerging market payments adoption. The lack of burn mechanics, the minimal product traction due to its age, and the sparse social engagement place it squarely in the highest risk segment of microcap crypto.
So even though the qualitative signals, the team, Circle, the utility are stellar, the financial structure makes it inherently volatile and susceptible to failure if that growth falters.
It's a fascinating dichotomy. High qualitative strengths countered by severe quantitative structural weaknesses in the token design.
What a contrast this deep dive has revealed. You have a team that is deeply integrated into the Solana ecosystem, securing a grant from a giant like Circle, and building a utility that addresses real-world pain with the promise of 30-second transactions.
And
yet they have made the fundamental decision to forego the very financial mechanics, the scarcity signals and fee alignment that drives so much of the speculative and investment market today.
this decision forces a really philosophical question onto the market. If the value of the SRF token rests entirely on achieving massive continent-spanning scale, will real-world utility alone be enough to overcome the fundamental lack of financial scarcity signals that most speculative crypto markets require?
Is a token that focuses purely on governance and utility sustainable against competitors that are engineered for continuous deflation? Or is this a sign of the next generation of infrastructure projects, where value is derived from actual usage rather than from algorithms designed to manipulate supply?
That is the core conflict for Surfcash, and it's something for you to mull or explore on your own as you watch this project develop over the coming months. If they scale, they prove that utility trumps scarcity. If they don't, it will be another cautionary tale about financial engineering.
Food for thought indeed, especially as this 13-day-old project navigates the next year.
Absolutely. Thank you for taking this deep dive with us.
We'll catch you on the next one.